We're in a period of time that's a little bit unprecedented, at least in our lifetimes. This is not the situation we were dealing with in 2008, 2009.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. As we continue on covering the latest developments in the gold and silver world, where we continue to see record central bank buying, also finally seeing the prices of gold and silver a little higher following Friday's labor report. Also had a Fed meeting last week, so we will be digging into all these things and more with Rob. So, Rob, it's great to have you back on the show with everything that you're tracking. And how's everything going with you today?
Everything's going well, Chris. Thanks for having me on. And I always enjoy coming on Arcadia Economics and talking to your audience.
Well, good to have you here, and certainly plenty out there happening in the world. And perhaps to start with, I'd love to get your reaction and any thoughts you had to the Fed's meeting last week, where interesting how it played out. A lot of people were assuming or feeling a little bit more optimistic after the statement came out, suggesting in some opinions that we might be headed towards at least a reduction in the rate hikes from 75 to 50 basis points in December. Then the press conference seemed like that had people bummed out, as he talked about continuing to be pretty hawkish. Although, what say you, Rob Kientz, of everything that happened with the Fed on Wednesday?
Well, I think people have priced in continued pretty robust rate hikes by the Fed. There seems to have been in some quarters of the Fed, although not officially, a softening of stance, saying, well, we may not do, the 3/4 point every time. Maybe we need to kind of watch it, which is not a surprise to me, because Powell said last year, before they started doing the rate hikes and the running off of their balance sheet of the treasuries that they hold and the other securities they hold, that they could reverse course if the economy, wasn't super robust, or they thought there were any issues and concerns. Although recent comments by the Fed indicate to me they're not going to stop. I think that they're looking at a couple of things. They're looking at getting the rate as close to 5 as they can, because they know when you hit a recession, you need 5 full interest rate points to cut to deal with that in a typical market. I don't think this is a typical market, but the Fed knows they at least have to get to 5. I don't think they're going to stop until they get there. I think if you look at persistently high inflation, they know that they have to keep it higher maybe than everybody wants, because they're worried about that inflation number turning this into potentially a hyperinflationary type of scenario. They've been criticized a lot, though. The UN came out and criticized all the world central banks for their tightening, saying, hey, what are you guys doing? Economies around the world are contracting. This is an issue for lower income people that have less discretionary income. And the UN on that topic is correct. But the central banks had been easing for so long that I think a lot of them believe that they have to tighten it down and not let it run away. They know that if they ease too much and keep interest rates low for too long, the economy could run away. And this is, and the Fed's not stupid, and they have access to all the data. So I personally think that they're not going to pivot right away. I do think if we have a major crash somewhere, they could start maybe not easing, but just going to more to a neutral stance in terms of interest rates and in terms of their balance sheet and how much they hold mortgage-backed securities and treasuries and things like that. But I think their ideology is they need to tighten. I think when Powell came in, he wanted to tighten right off the bat. It didn't work, but they wanted to. And I think he's got most of the rest of the Fed aligned with him. But I do think, the president has, and the administration has criticized it. The UN's criticized it. Certainly the scream-o-meter of the mainstream media has criticized it and screamed bloody murder, because their precious stock sponsors that pay them, to run ads are not doing as well. So obviously the paid for and bought mainstream media doesn't like it. But at the end of the day, I think the Fed's probably doing the right thing in tightening here. I do think, since we're so late in this, what I call a super mega cycle of the dollar's world reserve fiat currency, they're not going to be able to stop the inevitable crash. All they can do, and this is an analogy I've been using, is manage this Titanic as it goes down and try to do as slowly as possible. A lot of criticism for the Fed this week, and just random articles I'm reading from independents about how the Fed is now creating a crash or creating issues in the economy. I'd like to remind people that those issues exist because of the actions of all previous political administrations, the Congress, who vote in the spending, your local representatives that we voted into office, all past presidents, all past Fed presidents, and all past Fed participants. And this is not something that's just a characteristic of the Powell Fed or the Biden administration or Trump or any of that stuff. And look longer term, this system was never designed to be in place long term. It was designed as a bridge to a different system. That's something I've talked about on your show before. They knew back in the late 1800s they're going to eventually have to go to negative interest rates in this system. They knew. They just didn't have the mechanism to do it. The technology wasn't there, but they knew. And the author of the current economic system, or what people have adopted as the current economic system, John Maynard Keynes, knew it because he talked about it in his writings. He talked about Silvio Giuselli, these guys that were talking about negative interest rates and the eventual end of the debt-based system. And now we're transitioning into a non-debt-based system, which are going to be the central bank digital currencies. And all the Fed and the rest of the central banks are trying to do is manage it as we get to that point. All the central banks have already said we're going to do central bank digital currencies. They're going to get rid of debt. They're going to try to force out cash. It will not happen overnight. It will take time. You and I were talking about that before the video. There are certain cash-heavy countries in which it'll take more time to get people out of using cash and get them into electronic forms of payment. The IMF knows this. They put this in their paper in 2015. They know exactly who they are because they have all the data on who's using cash. And they're going to focus their efforts on those countries to get them into CBDCs. I think that's a transition we're witnessing, and more what the Fed is doing now, like I said, is just managing this transition. And it could take a few years to fully play out for everything to happen. But we know what the new system is. We know the old system is dead, and we're just in that transitionary phase. So last point I'd like to make on this is be very careful of just taking anything that comes out in the mainstream media, or even, on my channel or videos or whatever, at face value. Always look a little bit deeper, and always do it with an historical tilt to it, so that, because a lot of times history gives you clues. And while the future doesn't always go exactly according to history, a lot of times it rhymes, as some people say, or it has analogies or close ties to. And I think that the new system, while being new, is really just an extension of what the system was 150 years ago with technology. And it gives the central planners the ability to control more. And that's what they've always wanted. And that's why they're doing it. And they waited this long because, one, the technology, but two, the existing system that was in place, there wasn't a provocative reason for them just to switch. But with economies now crashing, real estate market is starting to roll over in the US. It was the last bastion of hope for investors in the US outside of gold and silver. It's now rolling over. Where are people going to go? We know what's going to happen here. And that's going to be the catalyst for the new system. It'll play out over the next several years, I believe.
Yeah, it certainly does seem like we're reaching some, I don't know if it's fair to call it an end point yet. Maybe that is not
inflection point, maybe
imminent, but the whole problem that we talked about in the Austrian economics community, where you lower interest rates and everything is good, yet the ultimate problem is when you start raising interest rates. And like you pointed out, we're seeing that reflected in the mortgage market, where things aren't going well. We saw quite a scare in the British bond market, where rates really started accelerating. They had to step back in, and so far things have calmed back down a little bit. But like you said, difficult situation the Fed is in, and we will see how that plays out going forward. Although one note I would mention, we're recording on Friday here, and you see current probabilities up to 56% chance of a 50 basis point hike in December versus 43 for the 75 basis points. So it will be an interesting month to see what develops in between now and then. Rob, on Friday, we also had the labor report come out. It was interesting because payrolls were higher than expected, 261,000 versus 205,000, although the unemployment rate did go, that was also higher than expected at 3.7 versus 3.5. And we saw quite a rally in gold and silver on Friday. Silver up $1.20, gold up almost $40. Were you a bit surprised at that reaction in the gold and silver markets? Not typically what you would have expected based on that labor report.
Things go backwards of the way they should often in this market. You see the stocks rising on negative news when everything else is crashing down. You see gold and silver rising when we get a better than expected NFP report. We get a worse than expected NFP report, they fall, which is counterintuitive. So let's look at the markets as a whole for a moment and just look at it, look from a little bit different lens. I think we're in a period in which people don't know what to do, because if you look at past crises, bonds and the dollar, safe havens, bonds and the dollar. Certainly, milkshake theory is playing out now as Brent Johnson, would have you believe in that the dollar is strong and that it's getting, the DXY relative to other currencies getting stronger. I believe that, but when the dollar dies, that doesn't apply. What happens when the dollar dies? Are people still going to go to the dollar? Are they still going to the bond? There's de-dollarization going on, Belt and Road Initiative from China, the BRICS nations, people setting up alternative currency systems. Do people go to the dollar and the bond now? I think the market's confused. And what I saw, and I wrote this article for Jam Bullion and put a video out on our channel, I was looking at the bond market, and I did a video with Independence Money, Nathan and Amanda, which came out last night, I believe, on our channel, Thursday night. We were talking about the bond market. The bond market looks schizophrenic. If you look at like a technical indicator, there's something called the MACD, which is a moving average convergence divergence. And what it tracks is longs and shorts and how wide apart they are. And the wider you have a divergence on that MACD, the more schizophrenic that market is. And you're starting to see massive indecision in the US bond market. People don't know where the hell it should go. Should I buy bonds? Is it a safe haven? Is it not a safe haven? The market doesn't know this time. And you can see it in the data. If you're a data geek like me and you love looking at data, I know a lot of people aren't, but thank God for people like me who are dorks and do this kind of stuff. When you look at the data, you can see it's a schizophrenic market. And so nothing surprises me in gold, because I think half the market thinks gold should rocket, and the other half of the market says, it's a barbarous relic. People don't know. And if you look at if you watch CNBC and Bloomberg, the screaming meter, they don't know either. I think they're still kind of freaking out about what's going on. And so the traditional narratives, Chris, that may have taken place in the past, maybe that narrative is changing. And I think, and I've written this in the past couple of weeks, that people will come back to gold. There's something about gold and silver that over history have stood the test of time during crises, and I think people are going to come back. But what many have said, many more smarter than me, is at the end of this fiat system, we're going to have wide swings in a lot of asset classes. Alistair McLeod has written about this. Tons of people have written about this, that I respect. You're going to see $100 swings in gold every day. You may see $3 or $4 or $5 swings in silver. As people figure out, where do I go? What do I do? And remember, spot prices in gold and silver are determined by derivative market, not physical trade. So while people are taking physical off the markets, we know that every market wrap up I do that I put out on Sunday night, we talk about silver stocks, gold stocks, the Comex. Rafi talks about all the time on your channel. People follow him. We see in the runoff in silver. So the physical market is, and we're seeing some of it in gold as well. The physical market is strong, but the derivative market's like, they don't know what the hell to do, because they're not in it for the physical. They're in to play it either to counteract some hedge that they have, or they're in it to play, make money, pennies on the dollar on a trade. They're not looking at fundamentals. If they looked at fundamentals, gold would be sitting at $3,000 right now. Give me a fucking break. I'm sorry. They don't know what to do. So I look at the spot market and I think it's a clown show. It's a clown show of clowns that don't know what to do in the market, led by the bullion banks who are the smart money, are going to rob everybody blind in that market. And so while I document the clown show every week, it doesn't worry me that much. And the fact that it's given contrarian indicators to what it normally does makes sense to me in light of people who trade those markets that determine spot price don't understand, but the people who do understand or are buying the physical get it. And so the smart money, or the bullion banks and the derivative markets, going long silver and positioning long in gold, by the way, another thousands of contracts of gold going long on the bullion banks. So they're positioning and getting that long in gold, and it's been going on for months. So that smart money, the derivatives trade, is positioning long. The physical buyers are positioning long. Are they going to be right? Am I going to be right? I don't know. I certainly hope so. There's at least some place for people to go for safety as this system kind of comes, slowly crashing down. The Titanic takes on water and starts to sink. But I would caution people, if you're just looking at short-term signals, be a little careful, because we're in a period of time that's a little bit unprecedented, at least in our lifetimes. This is not the situation we were dealing with in 2008, 2009, which was primarily a mortgage-based fiasco and a few banks and liquidity and repo market. The problem is much bigger and deeper now. It's not the tech crash. The problem is much bigger and deeper now. Although I point out, You see Amazon coming under a tremendous amount of pressure. I had Chris Galizio, a money manager, on my show a couple months ago, said Amazon's in trouble. And now Amazon's saying basically zero profit. The only thing holding up is its cloud. And now it's got Google and Microsoft taking market share from it. So Amazon may be in a bit of a trouble right here. They're still making money, still got profit, but they may be in a bit of a trouble. But if you look at the tech crash, when that happened, most of the big players in the tech industry dissolved and new companies arose. And I think when we go through the market this time and the tech stocks begin to crash, some of them are going to crash and go away, and we'll have some new ones rise. And that could be opportunities on the other side for investors, although I don't know if I'd advocate getting into tech stocks right now. So there are going to be a lot of contrarian signals to people. So be careful looking at short-term signals and making investment decisions. Look longer term, understand the history of things, and just make your decisions that way.
Yeah, I think that makes a lot of sense. Obviously, we've seen quite a downturn in the tech sector and all of the stock markets in general. So I think people are feeling that. And Rob, do you think that's connected with why we've seen increased premiums and significant demand in silver in particular? Or do you think that's just more so the gold and silver crowd rather than the mainstream coming in? Feels to me as if so far it's a little bit more of the latter, where I think the gold and silver people are watching this and a bit concerned, as opposed to the average person out there who's looking at their 401k turning to silver yet. But we have seen a lot of buying and premiums getting jacked up and a lot of products getting hard to get. I would not say a silver shortage yet, although what would you say there? And what do you see in the conditions in the silver market right now?
Yeah, I think gold and silver investors are the watchers on the tower, or as my best friend in high school called me, the burning bush. We kind of look out ahead and try to warn people about what may be coming. We're the Paul Revere on the horseback riding through town saying the British are coming, long before the British ever launched their ships from England. A lot of times people look at us as kooks, but I think now, if anything, we've become the smart money. And yes, I do think that the gold and silver people and even the bond people, some of them are beginning to see the problems. And that's why you're seeing people repositioning in the market. In terms of silver, yeah, it's short. There's a runoff in silver. Comex, LBMA, where a lot of the ETFs sit, the passive funds. You see it coming off. Definitely people are pulling it. Is it industry? Is it investment? Probably a mix of both. I imagine industry is doing whatever the hell they can to secure silver, because I think industry knows silver is not in robust supply right now. Yeah, and thank you for pulling this up. It's a good chart from Gold Charts R Us. The first top three lines are Comex, the American exchange. Below that are the ETFs around the world. Most of that's in London, not all of it. Even some of the SLV is stored in New York, but I think it's only about 20-ish%. And I think the rest of it is stored in London. So the middle portion of this table really talks about the London stores. And there is some metal coming back on, by the way, not to Comex. Some of it's coming into the ETF. So there is some rotation off of the Western markets to London. But if you go and actually look at Shanghai, this astounded me. They're monthly, they put out a report in the Chinese market. 77.25% of contracts were physically delivered in China. 77.25. And their gold price is sitting somewhere between $43 and $43.20 higher than the Western markets. And if you look at what's delivered on Comex, you're lucky in a day if it's a tenth of a percent. And even in the big delivery months, about 6 of them a year, the next big one coming up is December. You're looking at, if you're lucky, a 0.5%, usually not even that much. You look at Shanghai, 77%. What's that market telling you? What that market is telling you is gold is being taken out of the Western markets and moving east. Because how can they trade that much gold, but you don't, in silver, but you don't have that much gold and silver to trade in the US or in London? So yes, it's leaving the vaults. A lot of it's flowing east. Probably a lot of manufacturers are grabbing it. A lot of investors are grabbing it. So I'd say the smart money has begun the run on silver. And when you look at the COT report from the CFTC, the bullion banks have been positioning net long every single week in gold. They're not net long yet, but they're getting there. It's going to take probably a few months left. So that few months, if they continue the trend and they do get net long in gold and silver at the same time, I think that's your inflection point where you would say at that point, okay, the sharp money says it's going to rise. That's probably somewhere in the beginning of when we have our next bull run. That's really what I'm looking at. Because to me, it's the physical that matters. I don't forget the derivatives. I don't care at this point anymore. I know the derivative complex is doomed. I'm looking at physical trade. And as soon as those bullion banks get net long in gold, I think that's where you're going to see the golden pop start to really begin, because I think they're timing it to where they know the financial issues, because all the big banks that trade the derivative markets know exactly what's going on economically. They're probably more data than anybody, even probably than the Fed. And so they're positioning for what they think is coming. So I think that's a good signal, the runoff in the silver and then the repositioning of silver and gold on the derivatives market. The next thing I would need to see is a runoff in gold, which hasn't quite happened yet. It's a little baby amount, but not a lot in gold.
Do you think the banks will be able to get to the point where they're actually net long in gold? I know as the hedge funds have been getting short, banks have been getting less short, although still traditionally quite short gold. So that would be quite a feat if they could pull that off.
Well, if you look at how this market works, and I've had this explained to me in bits and pieces by people much smarter, and I followed it a lot longer, and I've kind of taken all that and put it together. If you look at SLV, for example, huge short position, keeping the share price down, silver being liquidated. Why? Because somebody wants the silver. And if you destroy a bunch of shares, that usually bolsters the share price. So if you went and just redeemed all the silver at SLV, you'd have shares zooming, and you don't necessarily want that to happen, because you'd have a separation in the SLV price and the actual silver price on the derivatives market. And so what they do is they short the SLV and take the metal out. Where does it go? I don't know. We don't know. Nobody has the records. I suppose some to industry, some to investment. But that keeps the price down. Well, what does the SLV price indicate? Well, all the derivatives traders look at SLV price as a proxy for what silver should be. So then that's why you have it short on the derivatives market. So looking at how all the pieces interact, it's pretty damn obvious that prices should be much higher given the physical. They're not. And I think it's cover for people to go get physical. And in terms of answering your question about gold, yeah, they can get net long, because the other side of the trade, managed money, I had this explained to me by a couple of money managers. Managed money represents trillions of dollars of market. Think about all your passive funds, your hedge funds, Janus, anybody that runs, I don't even know if Janus is still in business anymore, but anybody, I haven't owned any of that garbage in a long time. But any of these big wealthy funds, trillions of dollars of market, dwarfs the size of gold and silver. So those guys could continue to lose for the next 100 years, and it wouldn't necessarily downwardly affect their portfolios, because they're only exposed to gold and silver just a baby bit. So can the bullion banks dupe all of these hundreds and thousands of hedge funds and stuff to go short on gold and take the opposite of their contract? Sure. Why? Because they have put out the research reports that all the managed money reads. It all comes from the banks. So the banks can say, well, short-term price pressure on gold and silver. And guess what managed money does? They go buy a bunch of shorts, or maybe managed money has exposure somewhere else. I don't know. But you see it. You see it in the COT report. Every time the bullion banks go longer in a week in gold and silver, the managed money goes what? Shorter. Who's absorbing that trade? All the money managers who aren't gold and silver people and who read the bankers' reports about where gold and silver is supposedly going. So this is how the whole thing runs. So you're getting a report from whomever that you trust that says, oh, gold and silver experiencing pressure. You go to your whoever's managing your money and say, okay, if we're going to do gold and silver, let's go short. And that's what happens. And the neck pride's cover for the bullion banks to go long. It's a wonderful system that they have set up that does not reflect economic reality, but does allow knowledgeable people in the space to continue to make money off that derivatives trade, which every time we see an article come out in the news about somebody getting fined for this, that, or the other, and manipulation, it also goes on to point out how much money they made. So I guess it's been lucrative for the bullion banks to do this.
Well, that has been the case. And one thing that you mentioned in there that perhaps will be the last one we'll wrap up with here is some of the deliveries. And I was thinking about this the other day, where Comex registered stockpile now under 35 million ounces. 35 million ounces would be about 7,000 contracts. And then as I was looking at the delivery report over the past year, I mean, it's interesting when you get down to that level, because here you see 9,000, 9,100 or 9,200 in December, 10,600 almost in March, as well as 6,805 in September. We have active delivery month coming up in December, so just in a couple weeks at the end of this month. What are your thoughts on that? Is it to the point where we can get a big delivery number and that becomes a bit of a problem in the silver space?
Yeah, with a bit of explanation, because these deliveries you see here are metal that's been physically delivered. A lot of times it stays in a warehouse, and it goes from what we call the registered category, which is the tradable stock that's liquid, what I call liquidity, into eligible, which is more private storage. Now, could that private storage come right back on the market any day, any second, in which the owner deems it? Sure. Nobody knows how much of that private stock really is available. CME Group, I believe, put out a report. Ronan Manley had on. He's had now written 2 articles on it. One very recently, one last year,
Right.
about how the CME Group basically admitted all of that eligible category, that private storage, which is in a Comex vault but not registered for trading on the exchange, could come back in if it's not already owned and pledged for some other contract. Maybe it's pledged to go to London. Maybe it's pledged to go to Samsung. Maybe it's pledged to go to a private holder. We don't know. And since those are private stores, when you see a report of how much gold and silver we have in the Comex, the eligible category, you have to look at it with a jaundiced eye and say, well, how much of that actually will come back? Well, it depends on price, depends on how much it's already pledged to something else. So it's a bit of an opaque market. And so whenever you see delivery numbers and then you see the actual stocks on the depositories, they don't match one for one, because a lot of that is just shifted around. And then in any given month, you can have people take gold out of registered and out of eligible and just take it off the exchange, and it was never delivered in that month. It might have been delivered in the previous month. So there's no way with the data that we're provided to do a little chart which says delivery, off exchange, on exchange, moved to eligible. You can get summaries, you can't track it. So since we can't track the metal, we don't know how liquid it is. We don't know ultimately who owns it. We don't know if there's multiple ownership claims. We don't know how much of it ever is coming back into trading stock and registered inventory. We don't know. All we can do is look at the macro trend of Comex has a lot less gold and silver, especially silver, available for trade than it did before. And I was talking to David Morgan on the phone yesterday, and he said, silver's getting to the point at which I start rubbing my hands together, is literally his quote. And he said, last time it got to this level, he thought that we might be at the point of silver capitulation. But what happened? A bunch of silver got dumped on the market. Next year, after that, Daniel and I covered Perth Mint and realized Perth Mint lent out a bunch of metal somewhere. Was it to the Comex? We don't know. Don't have a clue. But they were providing liquidity to the market. So I think there are signs that there's liquidity issues, but knowing exactly when that will happen, nobody knows, really. But when you look at the aggregates, it does give you a fairly good idea that, yes, we have less silver available for trade than we have had the last few years. It's still fairly robust. The market can still operate. But if that trend continues, yeah, that will become an issue. And so given that we've had such big deficits in what the industry is using every year to what mine supply is, that's where I say, for me, not financial advice, but for me, go in on silver. Because if this is not the event, then damn it if I don't know what is. Because what other condition would need to be there? The only thing that could stop silver from really popping at some point in the near future is if somebody has 1 billion ounces, they hid it for all these years and they dumped it, and they wanted to get rid of it at current prices. What are the chances of that? I don't know. Nobody knows. But everybody I talk to in the industry says it's probably less likely, given the fact that we need it for industry. And the need for industry is only going to increase year over year. It has to, with the way society is going and the relationship of silver used in everything. And so the way I look at it is, now's probably the time to go long silver if you were going to do it. And what I did was I took all of my fractional gold and some of my 1 ounce gold coins, gave them to my friend Ian that runs Arc Silver, and he gave me a bunch of silver. And I'm down to now just a little bit of gold left in my collectible gold coins, which I'm going to keep, but very little 1 ounce or bar gold. I have a little bit, but not much. And I'm really heavyweight silver, and I could really be wrong on silver. But I'm willing to take that shot because the data looks to me like, hey, it looks like we're probably closer to this than we have been in the past. One caveat, If somebody has 1 billion ounces and dumps it, that'll buy you a couple years. How many people have it? Don't know. I've been told that the Mormons, and probably this happens with a lot of organized churches and various organizations that have existed throughout history, have accumulated a lot of precious metals and things like artwork and things. So it wouldn't surprise me if there are stores that organizations that have lasted for hundreds of years and understand the value of gold, silver have. The Vatican probably has a lot. The sovereigns have a lot. They're gobbling up gold. We know that. How much of that will be liquid, I don't know. So those are other interesting things to consider. There's probably stores of stuff around. Who's going to give it up? And in what condition, at what price would they give it up?
Right.
But it wouldn't be as robust as having 100 million ounces sitting on Comex.
Yeah, certainly going to be interesting to see how it plays out. And I like to be careful not to suggest to people, well, next month you're going to wake up and silver is going to be an astronomical price. But we look at mining supply coming down over the last 5 years, seeing deficits in the overall numbers. And then when you factor in what's going on in the world where inflation is soaring and banks raising rates right now, yet not having the easiest time doing it. So will be an interesting environment. Although fortunately, to dig into all these things, Rob, I know you'll be joining us this weekend on Saturday for SilverFest 3, where we're going to be talking about silver all day. It's free for people to attend. Fortunately, it's live, so we will be able to take questions. You'll be joining us for a couple of these panels. I see you there on Silver Outlook for 2023, as well as Ask the Experts. And we have a bunch of people that you see on the show. And Rob, hopefully we'll be able to get you into one of the booths at some point as well. So if people want to interact with you directly, they can do so. So excited to have you there. And link to sign up for that is in the description field below. So we will be there all day on Saturday. And Rob, perhaps you could just let people know until then where they can find all of your great research.
Yep. So you can just go to goldsilverpros.com, find Gold Silver Pros on Twitter and YouTube. And I also write now for JM Bullion and do content for their YouTube. So just look up JM Bullion .com/blog. You'll see me there. And you'll see me on their YouTube channel twice a week. We do the weekly market wrap on their channel and also an independent research piece, usually on Thursdays or Fridays as well.
Well, appreciate all you're doing out there in the world, also making some time to break things down today. And we'll look forward to seeing you on Saturday. And thanks again for all you're doing, Rob.
I'm going to be down in South Padre for this event. And I can't think of a better place, Chris, since you had SilverFest 2 last year at the beach, for me to be at the beach this year. I took that as inspiration to be at the beach. So it's going to be a lot of fun. I really look forward to this. This is the industry event for silver, honestly. You have the best guests and always have a great time doing it. So privilege and honor to be a part of it. Thank you for inviting me. And I think it's going to be a whole lot of fun.
Well, looking forward to seeing you there. Again, we'll be getting started at 11 a.m. Eastern time, 10 a.m. Central, 9 a.m. Mountain. And yeah, I think it'll be a good place if you're interested in silver, just finding out about more of these things to join us. And you can see Rob and others as well. So Rob, we'll look forward to seeing you there.
All right. Look forward to it, Chris.
Well, thank you, Rob. Appreciate the great conversation. And it's always good to check in with Rob from Gold Silver Pros to find out what he is seeing in the gold and silver markets, as well as the other markets out there, including real estate and what's going on with the Fed. So appreciate you joining me, Rob. And before we wrap up, would like to thank Reyna Silver, who brought us today's episode. Reyna is exploring 3 properties, 2 in Mexico and 1 in Nevada at Medicine Springs, where they are hoping to find district scale high grade assets. And as you can see here, back in September 8th, they announced that they were getting ready to begin drilling at Medicine Springs. That has begun, where they have a 7,000 meter drill program. From their sampling program, they've already found 2 samples of over 1,000 grams per ton silver, and 10 of the 13 signs of an indication of a carbonate replacement deposit. And the drill program is designed to define the thickness of the rock host package, continuity of the mineralized structure at depth, and support Reyna's exploration model. One of the things that is good is that when those CRD systems get big, they are usually high grade. So will be exciting to see as they begin to have results from Medicine Springs. And Thank you to Reyna for bringing us today's episode. You can find out more about Reyna at reynasilver.com. With that said, going to wrap up for today, but I will see you again tomorrow.